Ever wonder why some people seem to have a knack for making money? Could it be that they simply know more about money than the rest of us? The truth is, understanding the language of finance is a key factor in making informed decisions about your money. Today, we're going to unravel the mystery behind 25 common financial terms. By the end of this video, they'll be a part of your everyday lingo. So buckle up, folks. Get ready to expand your financial vocabulary. First up, let's tackle 5 basic terms: asset, liability, interest, principal, and dividend. An asset, in the simplest terms, is something you own. It's a resource with economic value that you expect to provide a future benefit. Think of it like a treasure chest. For instance, if you own a house, that's an asset. It has value, and you can potentially make money from it by renting it out or selling it. On the flip side, we have liabilities. These are what you owe. Imagine it as the weight you carry on your shoulders. If you've taken out a mortgage to buy that house we talked about, that mortgage is a liability. It's money you've borrowed and must pay back. Now, let's move on to interest. Interest is like the cost of borrowing money. It's the price you pay for using someone else's money. Think of it as a rental fee for the money. If you've ever taken out a loan, you know you don't just pay back what you borrowed. You pay back that amount plus a little extra. That extra is the interest. Next up is the principal. This is the original sum of money borrowed in a loan or put into an investment. It's like the seed you plant in the ground. For example, if you borrowed $20,000 to buy a car, that $20,000 is the principal. Lastly, we have dividends. These are payments made by a corporation to its shareholders. It's like a slice of the profit pie. If you own stocks in a company and that company makes a profit, you might get a piece of that profit in the form of a dividend. So these were the first 5 terms. Do they sound familiar? Moving on to our next set of terms: bonds, stocks, mutual funds, ETFs, and portfolio. Let's kick off with bonds. In the financial world, a bond is like an IOU issued by entities such as governments or corporations. When you buy a bond, you're essentially lending your money to the issuer for a certain period. In return, they promise to pay you interest at regular intervals and repay the principal amount when the bond matures. Think of it as a formal borrowing arrangement with a promise to pay back with interest. Next up, we have stocks. Owning a stock means owning a piece of a company. When you buy stocks, you become a shareholder, giving you a claim on the company's assets and earnings. Stocks have the potential for high returns, but they also come with a higher risk compared to bonds. Remember, the value of a stock can rise and fall based on a variety of factors, including the company's performance and overall economic conditions. Now let's talk about mutual funds. A mutual fund is a pool of funds collected from many investors to invest in securities like stocks, bonds, and other assets. This allows individual investors to diversify their investments and manage risks better. It's like going to a potluck dinner where everyone brings a dish to share. You get to taste a variety of dishes without having to cook them all yourself. Coming up next is ETFs, or exchange-traded funds. These are similar to mutual funds, but they trade on the stock exchange just like individual stocks. They offer diversification, are generally more cost-effective, and provide the flexibility to buy and sell throughout the trading day. Imagine them as a basket of different fruits that you can buy or sell at any time during the market hours. Finally, we have portfolio. In finance, a portfolio refers to a collection of financial investments like stocks, bonds, cash, mutual funds, and other investment vehicles. It's like a financial garden where you cultivate various types of investments to grow your wealth. Understanding these terms can help you navigate the world of investing. Let's delve into the next 5 terms: inflation, deflation, recession, GDP, and unemployment. Starting with inflation. Imagine you've been saving to buy a fancy new gadget. You've finally saved enough, but when you get to the store, the price has gone up. That's inflation in action. It's a general increase in prices and fall in the purchasing value of money. It affects everything from the cost of groceries to your retirement savings. Remember, a little inflation is healthy for the economy, but too much can erode your purchasing power. Next up is deflation, which is the opposite of inflation. It's when prices decrease over time. Sounds great, right? Well, not always. If people expect prices to keep falling, they might hold off on spending, which can slow down the economy. So while your money might buy more, there might be less money to go around. Now let's talk about recession. It's a period of temporary economic decline during which trade and industrial activity are reduced. Simply put, it's when the economy takes a nosedive. Recessions can lead to job losses and make it harder to get credit, but they're also part of the economic cycle and can lead to periods of economic growth. Next is GDP, or gross domestic product. It's the total value of everything produced by all the people and companies in the country. It's like the economy's report card. When the GDP is up, the economy is in good shape. When it's down, we might be headed for trouble. Finally, we have unemployment. This refers to the number of people who are actively looking for work but aren't currently employed. High unemployment can signal a struggling economy, but it's also a normal part of the economic cycle. As industries change and evolve, jobs can be lost and created. These terms often pop up in the news. Now, you'll know exactly what they mean. Now, let's explore some terms related to loans and credit: mortgage, credit score, bankruptcy, collateral, and refinancing. First up, we have the term mortgage. A mortgage is essentially a loan that you take out to buy real estate. This could be a house, a condo, or even a commercial property. The property itself acts as collateral, which means if you can't make your payments, the lender can take the property back. Next on our list is credit score. This is a numerical expression that represents your creditworthiness. It's based on your credit history, which includes your past borrowings and repayments. A high credit score can open up opportunities for lower interest rates and better loan terms. Moving on, bankruptcy is a legal process you go through when you're unable to repay your debts. It can help you get a fresh start by discharging some or all of your debts, but it can also have a significant impact on your credit score and future borrowing ability. Next, we come to collateral. In the world of finance, collateral is an asset that a borrower offers to a lender to secure a loan. If the borrower defaults on their loan payments, the lender can seize the collateral to recover their losses. Last but not least, refinancing. This is the process of replacing an existing loan with a new one that has different terms. People often refinance to take advantage of lower interest rates or to reduce their monthly payments. So there you have it: mortgage, credit score, bankruptcy, collateral, and refinancing. 5 key terms that play a crucial role in our financial lives. Understanding these terms can equip you with the knowledge needed to navigate the complex world of loans and credit. Having a solid understanding of these terms can be helpful when dealing with loans and credit. Finally, we'll look at the last 5 terms: insurance, deductible, premium, risk, and return. Insurance in the financial world is a contract that protects against potential financial loss. It's like a safety net there when you need it most. The deductible is the amount you're responsible for paying before your insurance steps in. It's like the first line of defense in a financial storm. The premium is the price you pay for this protection, typically on a monthly or annual basis. It's your ticket to peace of mind. Now let's talk about risk. In finance, risk refers to the potential that your investment could lose value. It's the thrill of the financial roller coaster. And finally, the return. This is the money you earn from an investment. It's the sweet reward at the end of a well-planned financial journey. These terms are key to understanding how to protect your finances. So, there you have it, 25 financial terms that can help you become more financially literate. We've navigated the jargon-filled world of finance, underscoring the importance of these terms. They are not just fancy words, but vital tools to help you make informed financial decisions. Understanding these terms can turn the intimidating world of finance into a navigable landscape. Remember, knowledge is power, and when it comes to finances, it's also wealth. Thanks for tuning in. If you found this video helpful, give it a like and be sure to subscribe. Remember to turn on the bell for all the latest content from Money Masters. Until next time, keep mastering your money.